Is CVS Health, ticker symbol CVS, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of CVS using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what CVS is worth in today's stock market. Plus, I'll share a special bonus that could be the deciding factor when adding CVS Health stock to your portfolio. Right now, CVS trades for $55.74 per share. In the last day of trading, their stock price is down 0.41%. This comes after the company just missed on their most recent earnings call, and right now, CVS Health trades just slightly above its 52-week low. So far in 2024, CVS's stock price is down big, while the S&P 500 is up nearly 9%. In the last 5 years, things are slightly better with the company's stock price up 3.2%. They still lag the market over this time, but they were beating it coming into the beginning of 2023. Since then, things have been downhill. In the last decade, CVS has dramatically underperformed the market. Their stock price is down 27.4% over this time. But when we go back before the global financial crisis, in the last 19 years, CVS has compounded at 4.9% annually. They were actually beating the market for much of this time, and we'll see why they started underperforming in 2019 later in the video. Added to their stock price returns, CVS also pays a big 4.3% dividend. Those dividends plus the gains in their stock means that CVS has actually beat the market over this time. Surprising, right? Today, CVS trades just $2 above its 52-week low. This is still down $28 from their 52-week high. And how big is CVS? They're huge. Right now, they have a $139 billion enterprise value. CVS was one of Michael Burry's big recent buys. He's bought the business 5 times and he's sold out of it 3 different times in the last 4 years alone. His first round of buys netted him a very nice gain. However, this last time with the position of $3.64 million, he's lost around 21%. Michael Burry isn't the only super investor who has CVS in their portfolio. Overall, 10 super investors own the business, and it's the 29th most owned super investor stock. Both Burry and Richard Pezena bought big positions last quarter. CVS Health offers a diverse set of healthcare services. Its roots are in its retail pharmacy operations, where it operates over 9,000 stores, primarily in the United States. CVS is also the largest pharmacy benefit manager, which it acquired through Caremark, processing over 2 billion adjusted claims annually. It also operates a top-tier health insurer acquired through Aetna, where it serves around 26 million medical members. The company's recent acquisition of Oak Street adds primary care services to the mix, which could have significant synergies with all its existing business lines. Getting started with our first metric, we want CVS's average return on capital to be greater than 14%. Over the long run, it's a business's returns on capital that are really going to drive any gains in their stock. An average business earns around 7% returns, so we want to build in margin of safety and see a number that's double this. While CVS does earn decent returns on capital, they're not necessarily stellar. They have grown these from 7.36% in 2019 up to 8.78% in 2022, and in these intervening years, they've been around 8.5% to 10.5%. Still, when they're averaged out, CVS Health earns around 9% returns on capital. A little better than average, but it's below the benchmark we wanted. This is an X on metric number 1. In our second metric, we want to see growth. This is because it's harder to make mistakes investing into high-quality growing businesses. In the last 5 years, on the back of these acquisitions, CVS has grown their sales by 40%. Their earnings have also grown by 10%. However, the business's free cash flows are down 22% in their last 12 months. We can look at their cash flow statement to dig deeper and find out that this came from a $4.3 billion charge in their other net operating assets. Dig into the company's filings to learn more about it. Also to keep in mind, in 2022, the company had $8.3 billion in losses on the sale of assets and legal settlements. This came as the company announced settlements related to the global opioid epidemic. Without that charge against other net operating assets, their free cash flows would have been up, but because we have this, it's another X on metric number 2. Even though they're not starting great, we'll see if CVS has what it takes to turn it around later in the analysis. Next, in our third metric, we'll look at the company like an individual shareholder. We want to see earnings per share growth, and overall, their earnings have grown pretty steadily. These were temporarily hit in 2022 where they declined by about half, but that was due to those legal settlements. Still, CVS earns more per share today than they did in 2019, and they've done this while having above average returns on capital. It's our first check of the day on metric number 3. CVS has also slightly reduced their share count, and they bought back around 2% of their shares outstanding. Metric number 4 is pretty similar, but it's even more important. Here we want their free cash flows per share to have grown in the last 5 years. In these fiscal years, it looks like that would have been the case. They peaked in 2021 and then were down going into 2023, but these numbers are still above the $7.99 they earned in 2019. However, due to that charge that we mentioned earlier, in their last 12 months, CVS has only brought in $6.36 worth of free cash flow per share. Because of that, it means these are technically down from where they were at half a decade ago. This is an X on metric number 4. So far, through 4 metrics, we have 1 check and 3 X's for CVS. Before we look at the company's debt and try to figure out how much they're worth, why don't we check in on our first bonus? Right now, CVS pays a big market-beating 4.3% dividend yield. However, we want to see that that's covered by their cash flows. Thankfully for the business, this has been the case. They kept their dividends the same between 2019 and 2021. Then in 2022 and 2023, they decided to raise these. Even as their cash flows have come down somewhat and today they have a tighter dividend payout ratio, CVS looks like it's still able to support their dividends using their cash flows alone. It's what we want to see, and this is a check on our bonus. But dividends aren't the only uses of free cash flow, so let's look at their balance sheet as well. In recessions, it's companies with too much debt that can have the biggest losses and even go broke. That's why we want their net debt to be covered by the sum of their free cash flows from the last 5 years. CVS has added on net debt over this time, but they've been pretty diligent about trying to pay this off. Their net debt spiked at nearly $81 billion in 2019. This followed their Aetna acquisition. Then all the way into 2022, they paid down $25 billion of this. However, recently, after an $8 billion deal to acquire Signify Health and a $10.6 billion all-cash deal to acquire Oak Street Health in 2022 and 2023, their net debt position is back up. Today, this sits at $68.7 billion, which is a little different from where it was at the end of 2023. Over this time, CVS has brought in $63.4 billion. That's pretty close to their net debt, but it's slightly below this. Also factor in that this doesn't include the full amount of Signify Health and Oak Street's Health free cash flows either. So it may not be quite as bad as it looks here. Still though, we want to be a little more strict on this metric because it does deal with their debt. Because of that, it's an X on metric number 5. Now, before we try to figure out how much CVS is worth, let's jump into our second bonus metric. This one's another key safety point for the business. We want CVS to have a current ratio better than 1.5 times. This is a key stock safety metric, and it comes from what Ben Graham, Warren Buffett's teacher, wanted to see from companies. Current ratio is a company's current assets divided by their current liabilities. It's a measure of short-term liquidity that can be a safety valve if they need to pay things in a hurry. CVS has had a relatively steady current ratio throughout the last 5 fiscal years. Today, though, they are sitting at the lowest this ratio has been over this time, and it does come in below 1. Ideally, we were looking for 1.5 here, so this is an X on our bonus. It may not be the biggest red flag in the world, but it's less than ideal for the business, especially on this safety metric. Now, the big metric of them all, metric number 6, which is also today's first valuation, we want CVS's average free cash flows divided by their enterprise value to give us a yield attractive to the 10-year treasury. That comes in just over 4% today. So we want to see a yield 5% or greater, which is around the S&P 500's historical average. Following the company's recent downturn, they have a $139 billion enterprise value. This adds their market cap and their net debt position together to look at CVS more like it's a private business. In the last 5 years, we learned they brought in $63.4 billion of free cash flow. In an average year, it means they bring in $12.7 billion. When we divide that by their $139 billion enterprise value, it actually gives us a 9.1% average free cash flow yield. That's way better than what we were looking for. Currently, CVS brought in $8.1 billion of free cash flow in their last 12 months. This means when that's divided by their enterprise value, it gives us a 5.8% current free cash flow yield. That's also higher than the number we were looking for and better than the 10-year treasury. It's a solid check on metric number 6, which kind of comes as a surprise here. If you think that's good, wait till you see our next 2 metrics. In our second metric, we're looking at CVS using a discounted cash flow valuation. Here we're taking the company's cash flows and using historical assumptions to grow these into the future. So this method can give CVS credit for some of their growth, especially with recent acquisitions. We're going to assume that CVS grows their free cash flows at 6.7% each year in the next 10 years. Then in the following decade, we'll assume that these grow at 4% annually. If we want a market-beating 15% rate of return, which is what Warren Buffett looks for from his investments, then at today's valuations, it looks like a DCF analysis says CVS is worth around $63 per share. Keep in mind the company's recent acquisitions have reshaped this business, and due to the pressure in their retail business, CVS has a low amount of business predictability. The company's valuations may also be on their side as they're trading below their median price to owner earnings in the last 10 years. That's also the case when we look at their price to sales, and they're just slightly below their price to free cash flow over this time. CVS looks pretty decent compared to where they've traded in the past and their abilities to produce free cash flows. This is why a GF value comes in at $112 per share for CVS, implying the company may be as much as 50% undervalued. This uses analyst estimates and where they've traded in the past, but it's not the end-all be-all. We'll still put all these together at the end of the video. Now, so far we've covered the numbers, but it's the qualities of a business that are even more important to Buffett. Let's look at a long and a short thesis for CVS before we put these together with their numbers to figure out what the business is really worth. Let's start with a long thesis first. Number 1, CVS's diverse operations create the opportunity to view a patient more holistically. By managing both medical and pharmacy benefits, this could lead to revenue and cost synergies for the organization. Number 2, the firm's entry into provider services has the potential to improve returns for all of CVS's segments, if they can help patients more easily and more cost-effectively manage chronic conditions through early interventions. And number 3, CVS's pharmacy benefits management remains an industry leader. This is due to its intense focus on pharmaceutical cost trends that should continue to attract clients. But it's not all positives. Let's look at a short thesis as well. Number 1, healthcare reform will likely remain a recurring political topic in the United States, and CVS's stock may experience volatility if scenarios that threatens its prospects gain traction. Number 2, foot traffic at physical retail stores could continue to decline as consumers increasingly favor online retailers. This creates the need to reinvent its retail stores' operations. And number 3, due to the challenges in their retail operations, their profit growth prospects appear lower than its managed care provider peers. Now let's put everything together. So far in our fundamental analysis of CVS Health, stock ticker CVS, we learned the company goes 2 for 6 on the Select 6 analysis. They hit 1 of 2 bonuses by covering their dividends, but they don't have that current ratio we were looking for. They earn slightly better than average returns on capital, they've grown, and they do look attractive compared to their current free cash flows. However, they have challenges when it comes to their retail operations, integrating these recent acquisitions, and they have the potential for more ongoing legal settlements. Still, it's important to use common sense and do what's right for you. Remember, this isn't financial advice. When we put everything together for CVS, it looks like a fair value is about $85 per share. That's up $30 from their stock price, and it looks like CVS is undervalued. Be sure to share your thoughts in the comments. If you want to learn about more opportunities in the market, watch the next video and sign up for our investing tools to make requests, track more than 67 stocks, and get exclusive bonus coverage.